From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matt Meehan alongside my partner, the Professor Luigi Rosabianca. What's going on, Lou?
Matthew, how are you, pal? Missed you since the last one. So, Matt, what's happened recently with this gig economy and everyone's ease of access to social media and the internet is we had a lot of businesses being disruptive. Medium-sized businesses, large businesses, big titans being disrupted. I mean, the travel agency business was turned upside down over the last 10 years. But no one, till today, has seen fit to take on the stock exchanges. Joseph Cecala, welcome to the podcast, and tell us, what is the Dream Exchange?
So thanks for having me. So, yeah, I mean, exactly. A little frightening the way you put it, but yes, we're absolutely doing that. So the Dream Exchange is a stock exchange in formation. Actually, it's two stock exchanges in formation. One is a national market system exchange, which will be a direct competitor for order flow with New York Stock Exchange or NYSARCA and the NASDAQ. And the others that are there now, Members Exchange is a new exchange, CBOE, BATS. So all of the other exchanges will be licensed to be a direct competitor of those exchanges. But the other very relevant, very interesting thing we're doing is we're working on legislation that's actually passed the Congress, a couple of times in the past. There's been a 2-year distraction, but it's called the Main Street Growth Act. And that is the act which authorizes the existence of venture exchanges. And our group has weighed in very heavily. We were instrumental in an 8-page amendment to that bill, creating the market structure for small cap IPOs in a customized exchange environment called venture exchanges. And it also establishes a new type of security called a venture security. So the Dream Exchange Venture Exchange is also under construction, and hopefully we'll see that legislation move in the next 12 months. And really to address the underserved marketplace, which includes a lot of entrepreneurs with extremely valuable ideas, but they're struggling through the VC, private equity, angel investing marketplace where they have very little leverage and are raising capital is very difficult in that environment. And the public company setting would give them leverage. It would also give them a vehicle if good VCs want to invest. There's a vehicle by which it could be done. So that we're pioneers in that.
Now, Joe, let me just ask you one question, and let me dumb it down for myself and hopefully for the audience as well, because I know you and Matt are going to delve into some really sophisticated talk soon. So I'm a $20 million business. I manufacture widgets, and I have no possibility of being listed on any big stock exchange. How can I work with the Dream Exchange?
Right there, you are the $20 million widget manufacturer. We love you. And you're not feeling love from the large exchanges. So what we're doing right now, like how to participate right now, where's the field for this? We've actually created something called DreamX Connect. So DreamX Connect is our version of a business social media platform that's sort of like in the vein of a LinkedIn, but for the companies to be able to have a menu-driven profile. So if you could start creating your profile in DreamX Connect. There are investor profiles in there. We've barely launched it. We have 2,000 identities in there already. And what we're doing is looking pre-exchange launch at who our candidates will be in the future, because there's a significant preparation phase. It's not like you wake up in the morning, you say, I want to go public, and you run out to the public company Starbucks and get your public company cup of coffee. It's a lengthy process. And so the widget company, what we find is, and this is, we're quite scholarly here. We do a lot of research. what we find is that there are 5 key metrics, 5 key factors. I won't go through them here because you can read them. If you want to really get to sleep one night, there's a white paper that I'm the author of. It's called Low Visibility Markets Acting as Stepping Stones to National Exchanges. It's published in Oxford University's Handbook on IPOs. It's chapter 9. So when we did that research, and I'm grateful to Oxford, they were really out there with this. We identified these 5 characteristics that can predict success. We know that if you're developing those 5 areas in detail, that the likelihood of you succeeding in a small capital market, public market, and then graduating to an exchange is substantially likely. And so what you can do is start working with us. Get in touch with us through dreamx.com. We know the data, and we can start you on the preparation phases that could be a year out. But what's critical is that as you develop those key areas, it tends to attract private capital investors because they know there's an exit. They know that at some point their private investment will have secondary liquidity because the chances of you going public are higher. And that's the greatest ignored question to widget company. Okay, widget company, and I've been doing this 30 years, and the primary question, I represented all the VCs and angel investors, and they would always ask me, well, it's a great business plan. It seems like it'll be very valuable. What's my exit? How do I get my money back? How do I recap profitably? And at one time, like I was saying earlier, it was between 700 and 900 small cap, 50 million and under IPOs happened annually. And today we have maybe 10 or 12. So what happened? Well, there's a phenomenon of the electronic trading that really crashed the small cap marketplace. And what we lost in that process was the entrepreneur not really ever paying attention to the possibility of going public. The thought of the entrepreneur is, I'm going to build this up. I'm going to sell it to a private equity firm. I'm going to sell it to a VC. I'm going to sell it to a big company. Maybe I can do a management buyout. But there's no way the investors' exits have become limited to the choices that are made in the boardrooms of VCs and private equity firms, rather than the general American investing public supporting what is the next LinkedIn and the next Zynga and Uber and Facebook. So we're really preparing now to have an inventory of really good entrepreneurial companies that have prepared themselves to kind of like having this align, the stars align, so that when we launch the venture exchange, which is it's more than a year out, but we've got an inventory of companies ready to go. And as we prepare the companies, in fact, it's helping them because, like I said, the private capital raise gets easier because there's a public company option to their exit, and they can see their liquidity. They can say, oh, I can recapture my investment profitably in shares of a new public company. So it's kind of a stage where we're at. There's a lot of other developments, but that's primarily the Dream Exchange, Venture Exchange, kind of what we're looking for in terms of communication with our current public, the promotion to our public today.
I love this. It actually gives small business and medium-sized business owners an exit strategy, just like you said. Most baby boomers that started a lot of these companies that have management teams with them, the only thing that they can do right now is sell to private equity, right? So they're kind of forced to take the terms if they want out. That's one side of the story. The other side is when you're starting a company, right? These venture capital firms, they tend to keep these companies private a lot longer, and a substantial amount of the growth is made during that time rather than when they go public these days. And you kind of got to be in the good old boys club to get inside of some of these deals.
We've shifted to a relationship-driven environment. So, and don't get me wrong, the old public company environment was a bit relationship-driven, but it was, middle market stockbrokers that and investment banks that looked at the company and went, great, this is a good deal. And it was a 20, a 30, a 50% rate of return. And what happens with the private company environment is you're right. There isn't a wealth transfer. Those private companies can really run the table on terms. They dictate terms to the small company. If it's a good company and it's paying, it's cash flowing and it's valuable, the time to public market today, if it goes public at all, is 7 years. It used to be between 3 and 4 years. So you see that the phenomena of the market is the relationship-driven initial capital raise, where if you don't have a good Rolodex, it's very difficult to raise capital, as well as the relationship-driven exit, because really PE firms are just trading companies today. They just buy and sell the entire companies, and you'll see PEs that do well. They build up the company. 5 years later, they exit to another PE. So they're constantly raising money to buy new companies, and then they're harvesting old funds to pay their dividends and pay their investors back. But that's a very, very, you got to be in that club. And if you're an entrepreneur, you're not in that club, you're hurting.
The only other option would be a reverse merger, but you get all the legacy issues from these companies that you buy. And I mean, between the intermediary fees, it just doesn't make sense 90% of the time.
Yeah, part of what we analyzed in that white paper was the entire reverse merger marketplace. So we actually hand gathered 1,600 reverse mergers and analyzed every single company. And when we did that, what we discovered was, first, there's all the barriers. Do you have a clean public shell or not? Okay. But more importantly, when you did reverse merge, those 5 characteristics had to be there or you were sunk. As well as the merger kind of takes place, you're in a market that is the OTC market. And I don't know, a lot of your listeners, I'm not sure if they understand this difference. There are securities professionals that sometimes don't understand this. The 1933 Securities Act says, it starts out with, you may not use interstate commerce to sell securities, period. Full stop. Okay, so how is it done every day? Well, there's only 2 ways. Either you file a registration statement with the SEC, and if that's the going public, right? So the registration statement is step A. Step B is being eligible to list on an exchange. So merely filing a registration statement puts you in the quote unquote over-the-counter marketplace, but it really doesn't give you the secondary liquidity of being on an exchange and having a liquid market where you've been vetted and reviewed and all the things I'm talking about earlier about. We want to help you get to our marketplace because we want you to have liquidity and share volume and analyst coverage. Now, and the other way, so there's the go public route, or you have to be exempt from registration according to one of 18 different exemptions to sell securities, that make you not have to file a registration statement. And that's the relationship-driven labyrinth that these smaller companies don't really understand. So we think that an automated, using financial technology, listing process and registration process will help get more companies to the table, and then we want to be the listing venue for those small companies in the venture exchange. So you're absolutely right. The relationships, we're building an entire new industry. There's going to be brokers and intermediaries and investment banks that really just dedicate themselves to this sweet spot, because what you said is the most important factor here, that the highest wealth harvesting that occurs in a company happens between its valuation somewhere in the $5 to $10 million range and the $100 million range. And that wealth harvesting, now, if you're a $100 million company, you're not totally out of the box to be public. Very few of those $100 million deals aren't happening. I think the average offering was about $180 million in the last year. But you're talking, we only have 200 total offerings. 188 of them are governed by NASDAQ, and their minimum market cap is over $100 million. So only the largest of companies are making it to the public capital markets. So what we're doing is giving leverage back to the small business owner and giving them the leverage to negotiate deal terms, have good wealth harvesting available to a broader audience of investor, because that, 5x, if you're a $20 million company valuation and you can go public at 100 million, that's a 5x. That's an enormously successful investment. And it doesn't have to be 10x. It doesn't have to be a venture capital unicorn for people to be willing to invest and see a company expand. I mean, I like 20% IRRs. I don't know about you, but
I think everybody does.
It's better than zero,
Yep.
Now, Joe, you mentioned that your emergent industry was in a little bit of a legislative quagmire. Where is this industry going in the next 5 years? I mean, we see the trends for young, small entrepreneurial investors. What's going to be the trend for small business owners over the next 4 to 5 years?
Yeah, that's a great question. So I don't necessarily know that it's a legislative quagmire. I mean, the Main Street Growth Act, so it started out as a 3-page bill in 2015. It was voted on in the House. I've had an unfortunate lesson in civics these last 5 years because I've been to Washington. I mean, I spent almost an entire year there, 2018. But
Hey, Joe, before you jump into that, hold that thought for 1 second for me, right?
sure.
Can we just give the audience some background? Because this isn't the first time you've done this before. You've done it very successfully in the past. So let's give them some color on who you are, where you came from, what you did, and then we'll jump into where it's going.
Sure. So a little my background. I'm a trained securities lawyer and CPA. I've been one or both of those for the better part of the last 30 years. Done a lot of private capital raising. I always represented the investors. That was because they could pay fees. And I learned that really what the investor wanted was the optimal transaction. So I ended up becoming unwittingly always part of the company team. I was really trying to help the company make sure the investment was successful. And I guess my kind of claim to fame was that, I was the lawyer for, at the time, the 3 partners that formed Archipelago in 1996. So I was at the infancy of how the capital markets work today. And we really did see the writing on the wall that financial technology and the internet were going to take over the old floor brokering at any exchange anywhere in the world. And the pioneer that was, the CEO of the company was Jerry Putnam. So Archipelago, and I joke about it because some people hear it and they go like, that's a series of islands in the ocean. That's an archipelago. No. So our Archipelago was really among the first 3 companies to ever execute equity trades using the internet. And they started that in 1996. And as I said, I was a lawyer there, but I was much more part of the, looking at securities compliance and how would the market change. Going back to the other questions, like what's going to happen in the next 5 years? Well, we really did nail the predictive, equity trading over the internet. And, Archipelago had a major investment from Goldman Sachs. Goldman then used the Archipelago trade matching engine to plug it into E-Trade in the 90s, which made liquidity and best pricing. This was the key back in the 1990s and before this was, we had 20 different stock exchanges. We only have 7 today. And at that time, a broker became a member of an exchange. And the bid and the offer were on that particular exchange. And that exchange wasn't obligated to match the best bid and offer on another exchange. So you didn't always get the best pricing trading on the Amex or the Philadelphia Exchange as you did on New York Stock Exchange or NASDAQ. What Archipelago did was it consolidated the marketplace for every exchange. And when you logged into the Archipelago system electronically, you saw in real time the best bid and offer across all exchanges. So naturally, volume of capital markets flowed to Archipelago like a fire hose. And, in a very short period of time, they went public. And in 10 years after it was formed, Archipelago really took over the New York Stock Exchange. So what now the little known name is NYSE Arca. So NYSE Arca is the New York Stock Exchange and carries about 30% of all equity volume globally. And so that's my background. I'm kind of a capital markets lawyer. It's not often that that stock exchanges start. So it's not like I have 100 of these. I will have done 2. So and I took all of that data and really looked at how the small cap markets were negatively impacted. I hate the word side effect. Pharmaceutical companies use side effect. There's just effects. Some of them are unwanted. Okay. And an unwanted effect of the creation of Archipelago and the island and Instinet and these huge electronic trading venues was that the stock exchanges, the investment banks, the intermediaries became very much a volume driven profit model. So if you couldn't do huge volume and instantaneously in trading in 7 milliseconds, well, you're not really attractive to the current public exchange environment. So the fact was that our necessity to change the very structure of capital markets was just huge. So the fact was this new birth of the venture exchange model was born from trying to make a correction to something that I'd helped create 25 years ago. It's like, oh, crap, look at this. You're a $50 million IPO. Your trading volume in the first year isn't going to average 40,000 shares per day for a year. So you're going to have 2 million or 3 million or 10 million share volume for a year. Well, an investment bank or an exchange is looking at $1 billion IPO. They're going to have 10 million share volume in the first 30 minutes. So how do you compete in an environment where the customers just physically can't provide a revenue model that makes it attractive to the exchanges or the investment banks? So what we've done in the venture model is we've kind of shifted things around. And going back to your point about like reverse mergers and the intermediary fees, we can govern that in the venture exchange marketplace with a brand new listing, not a stale shell. And the exchange itself, even if it's charging overall a 1% fee, it's the average fees for a reverse merger that's very successful. The average fees at outset are 17%. And then the dilutive effects, if you take in dilution as a fee, it's 47%.
Wow.
Right. So if you're an entrepreneur and you're raising capital, that doesn't include the capital. So if you're an entrepreneur and you're going to do a reverse merger and you've got a small company and you own 100% of your company, or maybe you've got a few investors, you own 80%. Well, you're going to take on new capital, which is going to dilute you down. Say it dilutes you down 50%. Well, now you're at 50% of 50% to get to a public market, and there's no market and there's no guarantee that there's secondary liquidity because you're in the OTC market today, which is commonly viewed as, kind of dogs with fleas. Like if you were a real company, you'd list, okay, which isn't true. There's plenty of good companies. There's about 1,100 OTC companies that will probably shift from the OTC markets into venture exchanges once the legislation passes. So sorry, you put a nickel in. I do this. This is what I do. I love my life. I love the Dream Exchange. I close my eyes. Dream Exchange. You put a nickel in, you're going to get a lot of Dream Exchange. So just cut me off, guys. If you think I've answered your question,
I can listen to this stuff all day. It's the world I used to live in.
It's my passion.
Audience and friends at home, let me just put things in perspective. What you just had right now over the last few minutes was Babe Ruth getting up and saying, well, I hit ball with a stick.
Yeah, Joe, I think you sold yourself a little short because Joe was instrumental in bringing electronic trading to the exchanges that are there today, right? So because it's one of the reasons that everybody can trade from their computer with such transparency these days than it used to be.
And that was the purpose. The purpose was to bring the capital markets to the consumer. I mean, if you go back and you Google, Jerry Putnam's statements to Congress in 1999, the entire statement relates to the fact that a consumer is really not in the capital markets on equal footing with his broker, because he's got to call the broker. Back in the day, you had to call your broker. The broker called up to the trading room. The analyst decided what the positions were. If you wanted to sell your stock for $100, by the time the chain of communication reached the trading floor and the floor broker making deals on the floor of the New York Stock Exchange, there's no guarantee you were going to get anywhere near your price. And what Archipelago did was, it was a point and click Windows environment where you typed in what you wanted to do, and instantaneously, Ameriprise, E-Trade, all of these electronic trading venues today offered the consumer tremendous leverage to be able to build his own equity, make his own investment decisions. He doesn't have to call his broker and get pushback. He can trade his own account. And we want that for the small cap markets. I think it's going to be so much more exciting, going back to the other question, which is what's going to happen in the next 4 years. Well, it's already happening. As controversial as it's been in recent past with like Robinhood, you're seeing there's a tremendous number of consumers that are participating in wealth building. Everybody has their own app and they have their own trading environment, and they buy and sell for their own account. And all we're doing is expanding the menu with the venture exchange, so that, if you really did want to invest and Uber entrepreneurs were eligible and got on a venture exchange, you could get into those investments at the earlier stages and pick and choose from a vetted set of companies in an exchange environment where there's secondary liquidity. There'll be market makers. So it'll be just like the big exchanges, except dedicated to that sweet spot of entrepreneurial companies.
Now, Joe, let me take my earlier analogy one step further. So now I've listed my widget company on Dream Exchange. How do investors and entrepreneurs provide me with capital? How's this work? How's the interface work?
So the listing process, there's a couple of different avenues that I haven't published the rule book yet. So a stock exchange is really a set of written rules by which the game of buying and selling securities is played. And our rule book, it's kind of your question is really, okay, what happens? What are the rules? What's going to happen in the game? So it'll depend upon how you chose to list. So our listing process today is going to be very different in many respects from the traditional IPO. A traditional IPO, you have to have an investment bank. You don't have an investment bank, you don't have analyst coverage, you're not going to be an IPO. So with the advent of the internet and the electronic environment and transparency, and we pushed for this last October, I think it's about a year now. For the first time ever, the SEC approved a new rule. And the rule is that you do not need an investment bank. You can issue what's called a direct public offering. And there's a great company that did this. Palantir did it. They were among the first, if not the first, direct public offering to simultaneously list shares on the New York Stock Exchange. We're going to take that exact direct public offering model. It's baked into our rules. So if you're a listing, you are a direct public offering, meaning that you've prepared all your documents, you have your paperwork together. The day you decide to go live, you can hire brokers and intermediaries. They'll do their red herring. They'll shop for your price. They'll run your order book. You can hire people to do that. If you choose not to do that, you don't want one investment bank controlling your terms, you can actually promote your company now to the general American investing public and do price discovery in your offering on that day. So if you're an exciting brand new company and you're not being dictated terms, you go right to the market on Venture Exchange, and there's nobody standing in your way.
So, Joe, with the Dream Connect platform, it's going to help them market the company as well, so they can take indications of interest of who wants to go public and price it out themselves on the number of shares.
Yeah, they have to do that for themselves. Yes, okay. That's correct.
The reason people hire brokers and investment banks is so they can get the story out, tell them what's going on with the company. But with the internet the way it is these days, the social media channels, the rule changes that have happened, it's quite possible for a company that has a good story, a solid foundation, to do it all themselves and save a shit ton of money.
That's exactly right. And even more than the money, because the fees generally, people are really always worried about the fees. Clearly, there's fees. Okay. I think that the cost of going venture, it'll likely, it could reach $200,000, $250,000 to cost to go venture. Okay.
Mm-hmm.
Here's the difference though. You're now not stuck with the order book for the book runner controlling the day one pricing, as well as deciding who's going to get what. And that dilutive effect to your earlier investors and to you as the entrepreneur, that dilution is massive. We want the entrepreneur to keep more of his company, and we want the early investors to keep more of the company. So the fact is that as the direct offering promotion happens, and what's interesting is we have a lot of crowdfunding platform people who are very interested in this for this reason. They've used crowdfunding. They've crowdfunded like crazy. Okay. They've built up their crowd. They've got excitement about their company. Maybe they've raised $1 million or $2 million, or now you can raise up to $5 million in a crowdfunding environment. Well, what's the secondary liquidity for your crowd? They have all invested. How do they get out? So what will happen is the momentum from crowdfunding, the momentum from like the social media type environment of DreamX Connect, that momentum will be carried into the public setting, and people will be. This is what's really important. There's actually investor protection in an exchange environment, so all your documents will be there. All that fee that you paid for is really going for something valuable, because now that secondary liquidity is available in a regulated environment. And what people don't realize is transparency increases share price. So we like to look at entrepreneurs and say, look, people throw their entrepreneurial shares around like feather pillows. Okay. Oh, what's the deal going to be? 80-20, and they're throwing around the shares of this entrepreneurial company to make deals, right? We look at shares of an entrepreneurial company like manhole covers. You do not want to throw those things around, because one share, if you're Netflix and you owned a share, imagine the profitability from people who are throwing one share around, much less 5 and 10% deals at those early stages. So it's not just price discovery, and it's not just the costs. It's the fact that the entrepreneur, I mean, I've been working on this exchange now. The research took years. I mean, I'm 14 years in on this. I'm an entrepreneur too. I've been working my way through the labyrinth of the process to raise my capital and do things, trying to maintain as much of my company that I've worked for 14 years of my life on, just like your audience. I don't want to have a multi-billion-dollar company and come away with 18 shares. I'm trying to maintain the dilutive effect on myself and my team. I've got a great team. Our CTO recently, he was the senior architect of the NASDAQ. So he just left. He didn't come here for the great pay and the bagel bar in the morning in our offices. He came because he sees the possibility of our tremendous expansion. He's like, hey, I can be part owner of an exchange, right? That's what your audience, I'm sure, if they're entrepreneurs in that setting, the primary consideration every day is probably, how do I get through the next milestone? How do I get through my working capital? How am I fighting with? I've often said, you're not a real entrepreneur unless you put your payroll on your credit cards at least one time. Okay. So that's what they're doing, right? Why would you do that? Well, some people are doing it merely to survive. Other people are doing it because they don't want to be diluted. They know that what they have is valuable, and there's just bad deal terms. And what we're trying to do is expand the marketplace so the entrepreneur can retain his own wealth. The early investor, wise early investor, gets to not only retain the wealth, but get the early stage appreciation, which is where the big numbers are. Okay,
Joe,
if
let
you
me
were,
just
yeah, go
jump
ahead.
in here in a second, but it also gives an entrepreneur the chance to attract talent with a liquidity pool,
Absolutely.
right?
Yep.
Not
Yep.
meaning, listen, a startup could be great today. We could give you a $10 billion valuation, but 3 years from now, before you go to public, you could be worthless.
Yeah. That story, that you're exactly right. I mean, I've picked this from various successful things, and we've kind of conglomerated what was working, what works in the market. And there was a company called secondmarkets.com, which was founded by Gary Silbert. Brilliant guy. Okay, really, really, I admire him. And when Second Markets started, they were looking for secondary liquidity in illiquid assets. I think their claim to fame was, I guess, the state of California issued tax rebates and forgot to appropriate the money. It was like $150 million. And the taxpayers who had the rebate, they had cash coming, and the state couldn't pay it. So Barry stepped in and said, hey, listen, if I put all of these taxpayers into a system, and I've got 150 up to 150 million, but if my investors are willing to purchase the tax rebate for 60 cents on the dollar, the state's guaranteeing the payment someday. So the taxpayer wants his money today. He's willing to take 60 cents, but my investor's willing to wait for the dollar. So he put liquidity into the environment. He bailed the state out of this major flap with all these people, and he created liquidity in an illiquid environment. And then he said, hey, I could do this with private company stock. And I think he had like Facebook employee number 40 or something like that. So he had this kid, he's a younger guy. He was early in on Facebook. He had shares of stock, and he wanted liquidity, but Facebook wasn't going public in 2009. They didn't go public till 2012. So they went to Second Markets, and if you had relationships and you could get through the labyrinth of documents, you could have bought some Facebook pre-IPO Facebook shares. And I think, if our research is correct, I think about $2 billion of privately held Facebook stock transacted in the 3 years before they went public, because
I actually
they had staff members who were sitting there going, I'm a 28-year-old guy who owns $200 million worth of Facebook, and I don't know when Mark Zuckerberg's going to go public. I'll take $100 million today and retire. So that is absolutely a feature of this, which if you have, and we've kind of structured in like where the incentive plans and what are called Rule 83B shares, and how all those shares will be eligible once on the venture exchange, so that your employees will have liquidity, the entrepreneur has liquidity, early investors do. And it's about freedom of choice. To be able to sell in your own determinism, for any reason or no reason. I could go on and on, but I've had these deals in the past where I've had very successful companies. I've had VCs or angel investors invest, and I've literally had these phone calls where the company owner calls me and says, hey, Joe Blow wants he invested 100 grand. His investment right now is worth 300, but he just called and told me, you think I could get the 100? I'll take 100 now because my kid's going to college, or I want to put a deck on my house. And now this entrepreneur has a brand new problem. His company is succeeding wildly, and he's got to go out and do a private placement to get 100 grand to get, Joe Blow to get his deck on his house. Yeah. So this solves all those problems.
Yeah, back to your point about Facebook, I actually spearheaded the fund that actually did that. We went and we bought employee shares in the secondary market. There were a couple companies back then, shares post second market, like you were speaking about. It's huge, because you got to realize, and I don't think a lot of people realize it. Yeah, these people may be worth millions of dollars, but it's only on paper, and they take a small salary in the beginning for a big payoff later on. But again, there's a point in life, if you start in your 20s and by the time the company doesn't go public, you're in your 30s, you have some expenses that come up and some things that you want to get out. So it's always smart to take some of that money off the table when you can. And I think your Dream Exchange is going to give people a larger opportunity to do that.
Yeah, that's exactly the point. Yeah, but very well said. I'm glad to know that I finally found someone. I've delivered. Uh, I go to colleges and talk all the time, and at MBA programs, and I'll ask, okay, raise your hand if you were able to get, pre-IPO shares of Facebook. And I think in the hundreds of MBA students, I've had one who's actually said, yeah, I went to this guy and I gave him some money, and then we're working with second markets. Or I'm like, but thank you for acknowledging that actually happened, because sometimes
It
it's
still
like,
happens today.
yeah,
It
it's
was
still
just
happening
done with
today.
SpaceX. It was done with the Boring Company. It's done every single day,
Yeah.
right?
Yeah.
And what you're doing is you're having these investment banks, mid-tier brokerage firms,
Hmm.
set up funds, SPV products, going to the cap table and buying these directly from the employees.
Yep.
Most of the time they're marking it up, right? And then
Yeah.
reselling it to you, which is okay because they need to make money too.
Mhm.
However, everybody loses out on that deal. I think you're giving so much transparency to the employee, and the employer has a huge benefit. Joe, I am so happy we got to meet and you came here. I definitely want to stay in touch, but I also want to be respectful of your time. So can you just do me a favor, and can you tell everybody how they can get into contact, how they can find more on DreamX, on the socials, on the web? Where can they find you at?
Okay, so our website is dreamex.com. And through there really is everything. So you can click to our Twitter and our Instagram and Facebook and all of our social media there. In addition, it'll take you on a link to DreamX Connect, which is a separate website, which is where the social media website is. And if you want to email us, it's interesting. I get a lot of great emails. Um, First of all, I get a lot of cheerleading. I'm always grateful for that, because believe me, this has been a labor of love. But if you want to get directly in communication, it's info at dreamex.com. So dreamex.com. And that'll get routed right to two people. It goes to our VP of operations and our chief operating officer, and they look at every email. So if you email us, it's not like, oh, it's going into the waste bin. We read every email. We're a lean team. We have 17 people. And if you want to get directly in communication with us, it's not hard. I'm very transparent. We're going to be doing seminars and kind of symposiums over the next year, probably in about 3 months. We're going to do our first one, because some of the rule book hasn't been decided. So if you want to weigh in and say, I think that's a great idea. But what about this? I'm a small company. These are my concerns. I'm a trader. I'm an angel investor. It's a rare opportunity to weigh in on what the rules of a future stock exchange will look like. And believe me, it's a matter of when, not whether, this legislation will pass.
I love that stuff.
Joe, our mantra and purpose in life with Matt and myself is to offer programs and services to small businesses that were once only available to big business. That's what we do. That's all we do all day long.
Well,
and I think with your Dream Exchange, I think you could help us take that to a new level. So thank you for coming aboard. And I think Matthew's got some parting words, buddy.
Yeah, my man. Joe, look, you were instrumental in changing the capital markets. You're a lawyer. You're a CPA. You got big ambitions going forward. I got to ask you one question. What does success actually look like to Joe Cecala?
Yeah, that's a great question. And I get, I've been doing these podcasts, and I've had that question before. I have 6 kids, and this has become not so much about me. I can only live in one house and drive one car at a time. And so there's a certain element of course, I'm not ignoring that I want to be wealthy, but what really means success for me is that the Dream Exchange is a part of the financial fabric of the American investing system, where we are investing in things that enhance our ability to survive. To me, that's a success. Like, there's so many entrepreneurs with ideas and imaginations where if we can fluidly get democratization of the capital market system, where we can all go and support the best ideas, and Dream Exchange is a fabric of that for 20 and 30 and 50 years. to me, that's my success. I don't know that I'll see it in my lifetime, which is why I say it's a labor of love. It truly is. I want the Dream Exchange to have a ticker on the financial news channels just the same way the other markets do every day. And when I see that beginning to happen, that's when I know I'm actually kind of living a vocation of my own life the right way, because it's about my kids at this point and my grandkids. So that to me is what it means. We get democratization of our finances in such a way that we can quickly and easily support people who have the best imagination and give us a better chance at 7.5 billion people surviving on this planet or more. That's what it is for me.
Thanks, Joe. Hey, Joe, can I get you to commit to come back after the first company IPOs on the exchange?
Yeah, in fact, I've actually committed. There are a couple other people that we've had really good. This has been great, guys. And if you want me to come back sooner, we're going to have some very major announcements in the next 90 days. The last time we had a major announcement, we had 1 million people through our website. So after those major announcements, I'd be happy to come back. This is a great conversation, and I like your format, and I'll be happy to let you know in anticipation of that, and maybe we can schedule another time like this. And yes, maybe we can do one better. You can broadcast from the floor of the exchange when we open. We're picking our locations now, so I'll be happy to have you guys there.
Matt, do you think his success has anything to do with his last name ending in a vowel?
I don't know.
I think not.
Out these days. Hey, Joe, thanks so much, guys. This is a wrap of another episode of the Liquid Lunch Project.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.